All right. Why would that be? There we go. Just the picture. Let me. So this is from ERS as of February, and just looking at working capital to gross revenue. You know, as our interest rates rise and land values have stayed high, producers, land purchasers will want to kind of keep track of where that working capital and where their financial position is in making these longer term capital purchases. So on the national level, that's it's not real strong. We'll look at it a little bit closer, but it's not super weak either. You know, we're not down below 0.15 or 0.1. You kind of like to see it at around 0.3, so we're right at 0.2 as of projected in 23. In participants that participate in FinBin or a record-keeping group, these farms are taken from South Dakota, North Dakota, Nebraska, and Minnesota. And I did all farms in that area. So size didn't matter, it'd be small farms and some very large farms. And their working capital to gross revenue is quite a bit stronger than the national basis. So yeah, it surely has some bias selection to it because it is people that are participating in a record-keeping management group. So probably keeping track of things a little closer maybe than on a national level. But they have pretty strong, you know, really stronger than back when we were in 2012. And of course, this would be on an annual basis. So inventories at the end of the year in 22 were very strong. You know, crop prices were strong. If they were holding some in inventory, that sure made things look really strong on the balance sheet. And hopefully, guys, were able to turn that into cash and didn't watch it go down to $5 versus that $6.50 to $7 on corn anyway. So working capital to gross net revenue is just a measure of current assets minus current liabilities, and then divided by the gross revenue, either the current gross revenue or projected gross revenue. And just a good ratio to kind of keep track of over time and watch the trends of it for individual farms in saying where that working capital position is. The current rate, it's kind of replaced the current ratio in some fields of analysis. Others will compare working capital to total expenses. And I would say either one is fine for an individual farm. It's just what they might want to track and stay consistent with. So another way we're going to look at is earnings before interest, taxes, and depreciation and administrative expenses, or not administrative, amortization. Sorry about that. To debt, or debt to earnings before interest, taxes. And then just compare it to a Moody's rating, and we'll see that most it falls in that B, subject to high credit risk, kind of speculative class. So I got a graph coming up on this next page. So the red is right at I drew that at 6. I'll go back up, and 6 would be very highly speculative. So it'd be a CA rating in the Moody rating. I think my other line is drawn at 4. And that is subject to high credit risk. So you drop below 4, you know, you're improving. So the lower you are, the better investment grade ER. Oops, I went too far, wrong way, I should say. But I just thought it was kind of interesting. We're hanging right in there around 4. We were a little bit better position back in 10 through 12 as well, guys probably piled on and made some new purchases in this time frame when it was good, and then took on debt, and earnings had gone down through these times when crop prices were low, and then crop prices started to come up, and we got some strong support through the pandemic support, and then into 21 and 22. Stronger crop prices and still pretty decent yields across the area. Again, this is for those North Dakota, South Dakota, Minnesota, Nebraska farms that belong to the record keeping groups. In that database, there's about 3,000 farms that participate in it in that group that I have selected. Here, I just wanted to show a contribution margin, and for each different level. I've got 3 levels here, like the low 20%, the mid 20%, and the high 20% as far as net return is concerned. And then just comparing that to the contribution margin for all farms. Just kind of wanted to show how they separate out. Nothing broke out on size. Took all farms. So you may have a smaller farm that's in the high 20% for net profit, and you may have some very large farms that are in the low. So they can float either way. Didn't break it out by size at all. Just all farms, and then compared it to contribution margin for all farms and what the difference was there. Just wanted to illustrate that, we have some farms that are very strong and they stay strong. We have had a little downturn the last year. And these mid-level farms, as far as net return is, they kind of hang around right where the all farm contribution margin is. So contribution margin being what's left over from revenue when we've taken out all the variable expenses. This contribution margin then is available for principal payments, reinvestment, withdraw. It contributes to those fixed expenses and then also family withdrawals if we're a sole proprietorship or partnership deal. Then just wanted to show net worth growth due to change in earned net worth. And this was taken, I started everybody out at the 3 million in net worth. I just wanted to show how fast, if they could consistently hold this level of growth, how quick they could grow or earn more net worth. And I just reused the rule of 72. So taking their earned net worth level and dividing it into 72. And that's how long it would take to double. So really just showed that high 20%. And that was here I did break by size. So 1,000 to 2,000 acres for the high, and the low at 1,000 to 2,000 acres. And then I just showed the high for a 2,000 to 5,000 acre farm. So our strongest in the past few years has been that 1,000 to 2,000 acre farm earning a net worth change of 17%. And then I just projected it out, if they were able to continue that, how quickly they could grow and have that strength. Part of this, I just want to show that, there could very well be some very strong financial position farms, and interest rates may not have as quick as an effect on land values as we may have thought or may think. Just showing consumer price index over last whatever that would be. I don't know if I can even do the math. 2023. I started out in June of 68 is when I started. So just showing that, and then this goes through June of 23. So just showing the consumer price index for all farms. I don't know if this thing is in the way here or not. That stuff bothers you guys' screen. And then I'm going to lay over it, or next we'll look at interest rates if we can move forward. And where did I go? What the heck? It's back.
We're good.
Okay. And that was clumsy. Okay, here is a 10-year treasury rate, and then I'm just going to overlay that with the consumer price index. And I think really just wanting to show, in Dr. Santos talked very in-depth and strong about this, how to curb inflation. There's probably still some work to be done to hit that target level of 2% in inflation. And just comparing it to history and when inflation was crazy and interest rates had to be raised high to get it turned back. And to me, you can kind of compare this 23 with where we are maybe back in here, and time will tell what happens with our inflation rate. I mean, we had a good kind of decent for July, showing it down, and we'll see if that continues. I think you talk around to people, labor is still higher priced and hard to come by. People are always looking for help, and even with an increase in wages. So just a graph showing the change in land values for our survey. And if you haven't participated in the survey, be sure send an email in and saying that you would like to participate. We're looking for third parties, lenders, appraisers, brokers, that type of thing. So we welcome those to participate in it, or if you have a group of that not producers, but that fall into that and are interested in partaking in the survey, we would welcome that. So over this time frame, and I'm not showing it here, we have seen almost an 8% or right at 8% annual growth since we have started this survey year over year. So I think land over the last 30 some years has proven itself as a good investment that way. The cash return is small, and especially now, we're not getting a lot of necessarily cash return. You're not getting a 20% return each year, but it's a long-term safe investment, not going to drop to zero as far as your principal goes, and will return a little bit on the cash side. So for this one, we took ag stats information, so National Ag Statistics, and compared it to cash rents and corn yields, and picked a variety of counties. So the higher risk counties be Aurora, Moody, probably Spink. Aurora and Spink and Brown. Moody and Lincoln would be the less risk, and as you can see, is that their rents fall much higher than we would down in Aurora, where we may have more risk and not near as strong a yield. And also then as Spink. So I guess that really kind of fell out where we thought it would. You know, if we think about it as a cash rent per bushel of corn, it probably runs around $1, so down to maybe 80 cents in these higher risk areas, and probably $1.25 to $1.50, maybe even a little more in the higher producing areas that are more consistent. I got one more graph that shows that. Well, it is really clunky today, and I do not know why. There. You never know if you're moving 3 slides ahead or 7, or disappearing completely. Okay, so this one just switched it up a little bit. Cash rent costs per bushel of corn grain, and basically for each dollar rent increase, it's going to increase the cost of corn almost 5 cents. So again, falling out where you would think that they were, you know, in the higher risk areas, down probably below $1 per bushel, and you get into the more consistent higher yielding and running anywhere from that probably $1.25 to upwards of $1.50. So I thought that was interesting and to share. Now, this is gross rent to value, and really kind of follows interest rates. So we're taking the rents that were reported in our survey and dividing by the land value that was coincided with that. And this didn't really change much from last year. I think both values went up and our rents had gone up. I thought maybe that would start to change, and I believe that it will. It's going to start getting in that 3 to 4% probably, and that's either going to have to happen with rents increasing or land values dropping. And I don't see rents being able to be pushed much higher with margins the way they are. I don't think that can stay long term. You can't pay $400 rent when the return is only, you know, less than 1,000. Total return is less than 1,000. So that'll be interesting as it moves forward. As interest rates increase, where will that adjust to? You know, will it follow as it did early when we started the survey? That interest rates tracked very close to that. So now I just took capitalization method, counting on reading my screen, and I got stuff that just won't go away. Try not to close you out again. So when I started this, rents were at 200. This was where the land values were according to our survey, and interest rates were right at that 3.2% on long-term rates. So you can see as the profit in crop or the return to rent from rent went up, that it was using the cap rate, it was easy to increase the value. So this is just the change, as this 50% is a change in the land value due to the increase in rent, and of course interest rates staying the same. And or if rent went down, then this would be the decrease from this amount. And then I do that on each level of interest rate, and then showing the change. I just went up by 0.5% on these until I got down here, and then I just jumped in 1% on 6.2 and 7.2. And we'll see if I can go. I got a couple more slides showing this. Okay. Yeah, so there I said, threw in that green check mark, you know, how can land values keep rising even with interest rates rising? Well, there was profit and rents were able to be increased, and there are probably some even above this 300. And even though interest rates had maybe climbed to that 4.5, we could still see increases in land values. And now let's go to this next one. And here, I guess I wanted to point out that at some point it is going to have an effect on land values. We can't probably keep pushing this rent area up, or the gross return to land up continually. And if interest rates rise, at some point land values will have to adjust, or we accept a much less return. And let's see what else I may have. I think that might be what I got for today. So here's a link to the survey, and I want to thank, you know, if you're on here and you have participated in the survey, or if you're watching it and have participated in the survey, thank you very much for doing that. We're always open for questions on land information. The Nest School has a real estate major in it, and so if you got students that are interested in real estate activities, a great place to go. We do a lot of our lease information, sample leases, structuring leases through the North Central region, which is a group of extension services throughout the North Central region. And that is housed, or publications are available from the Ag Lease 101. That's the website for that. They have discussions on different types of leases, not only just cash rent, but crop share, flex lease, leasing whole farms, buildings, bins, leasing cattle. So they have different publications on that, and then also some sample lease forms. If you have a person that's looking for a sample lease or an example of a lease, that's a pretty decent place to go grab one. And you can sure reach out to us, and we can get that for you. Then we have some of our grazing guys put together a grazing lease publication, which is basing it more on the productivity of the ground versus rent by acre. So looking more to what the land can actually carry, and maybe a more conservation type lease. I think that's what I have. I got a few. Let me get out of this slide, and we'll talk a little bit. So a few things that I'm seeing and get questions on that are maybe somebody has comments on, or can shoot me email or text, or some of the things that are going on is tiling and who's paying for that tile. In many that I see, it is the tenant that it does end up paying for the tile and makes that investment in additional tile to improve the ground. But then in return, they're asking for that they would have a longer term lease. And if it doesn't work out, that they can continue to rent it, they end up getting paid or reimbursed that. So that's prorated through there. Other things is if we're putting windmills would be another one. If we're putting obstacles in the way of the farming practices, what happens? You know, is the lease adjusted? Is that made? You know, are there any adjustments there? Other things? Yeah, I got a phone call. It'll get taken care of. Maybe.
Yeah, I'm bringing her out.
Anything else?